Number 1, which of the following is not a characteristic of common equity? It represents an ownership interest in the company. Yeah, that's a characteristic. Shareholders participate in the decision-making process. I don't like the word decision-making process, so I'm going to leave that for now. The company is obligated to make periodic dividend payments. Well, it's not obligated. So we know that that is not a characteristic of common equity. So I'm going to choose C. Now, why did I not eliminate B? Well, I don't like this decision-making process business at all. I would have preferred it if it said shareholders participate in the governance process of an organization, and they vote with their shares. That's governance. Decision-making makes me think that that's part of management, and there's a separation between ownership and management here. So I don't like the wording, but I have to take C because this is clearly wrong and saying which is not a characteristic. This is not a characteristic. That word makes me choose C. Had this been something different, then I might have said, well, B is not a characteristic of common equity because of that decision-making business. I don't like that. Governance, yeah, but decision-making, Number 2, the type of equity voting right that grants one vote for each share of equity owned is referred to as proxy, statutory, or cumulative. One vote per share. That's statutory. Number 3, all of the following are characteristics of preference shares except, so we're looking for a false statement here. They are either puttable or callable, callable or puttable. They generally do not have voting rights. They do not share in the operating performance of the company. Well, for C, they do not share in the operating performance of the company. I know that's true. That's not a false statement, so I can eliminate that. The second one, they do not have voting rights. That's generally true, so that's not a false statement. I can eliminate that. They are either callable or puttable. They can be callable or puttable. This is saying they are either callable or puttable, which means they must be one or the other. That's not true. Now, I don't like these kind of questions because they turn on grammar. This is more of a test of your grammar ability than it is a test of your knowledge. I don't like it when questions do that because that's not the point of this, is to say, oh, you got me on the language. Oh, tricky. I don't like that. I don't like that at all. But anyways, there's your answer A. Participating preference shares entitle shareholders to participate in the decision-making process of the company, convert their shares into a specified number of common shares. Well, that's convertible. So I think we can eliminate that very quickly, right? Receive an additional dividend if the company's profits exceed a predetermined level. Well, we're participating. We already said that they don't have voting rights, so we can eliminate that. There we go. Number 5, which of the following statements about private equity securities is incorrect? So we're looking for a false statement. They cannot be sold on secondary markets. That's a true statement. We're looking for false. So when I see true, I can eliminate it, right? They have market-determined quoted prices. Well, that's not true. They are primarily issued to institutional investors. Well, that's true, so I can cross that out. I am left with B. Venture capital investments can be publicly traded, do not require a long-term commitment of funds, provide mezzanine financing to early-stage companies. Well, venture capital investments cannot be publicly traded. It is private equity. We can eliminate that. Do not require a long-term commitment of funds. They certainly do, 5 to 10 to 12 years. Provide mezzanine financing to early-stage companies. That's exactly what it does. And you might be saying, hang on, explain this word mezzanine. We haven't come across it yet. Mezzanine is, if you look at your capital structure, you have senior debt, you have junior debt, you have preferred shares, and you have common shares. Mezzanine financing kind of sits in the middle of it all. Kind of looks like debt, kind of looks like equity. Typically, it's considered convertible preferred. So mezzanine means it's neither at the top nor at the bottom, but somewhere in the middle of the capital structure. Number 7. Now, I want to explain something about questions like this. Where there's a lot of writing in the answers. You're going to save yourself a lot of time if you can eliminate as you read. Typically what I do is when we have a question, we read the answers and then we tend to take the one that best suits the question. On this one here, when there's a lot of words, these will eat up your time. You want to eliminate as you read if you can. Which of the following statements most accurately describes one difference between private and public equity firms? Private equity firms are focused more on short-term results than public firms. Can I eliminate? I think so. They are not. It's the other way around. Private equity firms' regulatory and investor relations operations are less costly than those of public firms. Yes, that's true. That's true. They would be less costly because they don't have investor relations. There is no public market. They have private shareholders. So I can go ahead and circle B and move on because we're looking for which statement most accurately describes one difference. That does describe one difference. There cannot be two correct answers. So I know that. I can circle that and move on if I feel comfortable doing that. So if you're pressed for time, at the end, if you come across situations like this where it's like, I don't know, you read this, you go, yeah, that is true. Circle it and move on. If you need to get through 5, 6, 7 questions and you got like a minute or two left, do that. But we'll read the third one just to make sure that would have been a sound strategy. Private equity firms are incentivized to be more open with investors about governance and compensation than public firms. I think we can eliminate that. So a good strategy to follow with these kind of questions, almost any question, is if you can eliminate as you read, because if you eliminate A and B, C is your answer, move on. If you get to an answer that you know is correct, there's no point in reading the other answers. There can only be one answer. Now, when you first start the exam, you're going to read the question, you're going to do your underlining, you're going to read every answer, circle, but if you get to the end and there's 15 of them that you bypassed because you said, I'll come back to this, and you got 5 minutes left, you're going to want to follow that strategy. You're saying, I'll eliminate as I go. If there's 2 that I can't decide on, I will guess B, 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 or C, C, C. Always guess the same. Always guess the same. That'll heighten your chances of getting of randomly getting them right. And if you come across an answer that you know is right, just take it right away. All right, let's look at our next one here. Emerging markets have benefited from recent trends in international markets. Which of the following has not been a benefit of these trends? And here we're talking about the recent trends in international markets. I didn't cover this. It's right at the beginning of the reading. There are a few trends in international markets that have seen an internationalization of markets. But let's just go ahead and we'll do some review here if we have to. Emerging market companies do not have to worry about a lack of liquidity in their home equity markets. This is kind of a tough statement. I don't like the way that it's worded. I would have worded it as emerging market companies are less concerned about a lack of liquidity in their home equity markets. It's not that they do not have to worry. That's an extreme word. I would never have written it that way. If they're issuing internationally and they're listed on other exchanges like the NASDAQ or the New York Stock Exchange and they're still listed on their home country, the pricing action in the other market will determine their home price. It'll be the other way around. So, yeah, technically, but I would say less concerned about instead of do not have to worry. Emerging market companies have found it easier to raise capital in the markets of developed countries, yes, but we're looking for has not been. So those two we can eliminate because yes. Emerging market, now I can just circle C and move on, but we'll read it. Emerging market companies have benefited from the stability of foreign exchange rates. Well, if anything, there used to be stability of exchange rates till Bretton Woods. Once currencies became freely floating, they became more volatile. And in the last 10 years, since WTO, since '99, since China and the WTO, early 2000s, currencies have become far more volatile. So, in fact, there's less stability in foreign exchange markets than ever. So, I would say C is your answer on that one. Number 9, when investing in unsponsored depository receipts, the voting rights to the shares in the trust belong to the depository bank, the investors in the depository receipts, the issuer of the shares held in the trust. Well, the issuer doesn't get the voting rights. The issuer gives away the voting rights. You can eliminate that. So you just have to know, well, if it's unsponsored, is it the depository bank or the investors? And you'll recall unsponsored was the depository bank, sponsored is the investors. With respect to level 3 sponsored ADRs, which of the following is least likely to be accurate? They have low listing fees. They are traded on the NYSE, NASDAQ, and Amex. They are used to raise equity capital in U.S. markets. Well, if they're sponsored, that means the company is directly involved, which is pretty much what it wants to do. It wants to raise money in U.S. markets. They are traded on the NYSE, NASDAQ, and Amex. Level 2 and level 3 are. Level 1 is OTC, so this is correct. This is correct. Here we're looking for least likely, so we're looking for a false statement or something that we would find hard to believe. They have low listing fees. I would select A. That's least likely to be accurate. 11. A basket of listed depository receipts or an exchange-traded fund would most likely be used for gaining exposure to a single equity, hedging exposure to a single equity, gaining exposure to multiple equities. Well, on this one, if you didn't know what a basket of listed depository receipts were, or an ETF was in that sense, you said, I don't remember that. Well, you would just use logic. Well, if it's a basket of listed depository receipts, would we be talking about single equities? Probably not. You'd take C just on the wording. Calculate the total return on a share of equity using the following data. Purchase price of 50, sale price of 42, dividend paid 2. Well, I think we can do that. What is our end of period? 42. What is our beginning of period? What is our income? Over our beginning of period, over 50, 42 minus 50, negative 8 plus 2 is negative 6. Over 50, that is a negative 12%. This is just P T minus P T minus 1 plus D T over P T minus 1. Negative 12%, negative 12%. If a US-based investor purchases a euro-denominated ETF and the euro subsequently depreciates in value relative to the dollar, the investor will have a total return that is lower than the ETF's total return, higher than the total return, or the same as. Well, you bought it in euros and the euro depreciated against the US dollar. So when you sell it, you're going to get less US dollars back. You're going to lose just on the currency exchange. So you're not going to get the same return that you normally would if it were all in US dollars. Hence, you will be lower than the ETF's total return. 14. Which of the following is incorrect about the risk of an equity security? The risk of an equity security is based on the uncertainty of its cash flows. Yeah, that's true. So we can eliminate that. We're looking for a false statement. Is based on the uncertainty of its future price. Yeah, that's risk in an equity. We can eliminate that. Measured using the standard deviation of its dividends. Not of its dividends. Tricky, right? See, that is a false statement. We're looking for a false statement. 15. From an investor's point of view, which of the following equity securities is the least risky? Puttable preferred shares, preference shares are preferred, puttable preferred shares, callable preferred shares, or non-callable preferred shares, the least risky. Well, if I can put something back to a company at a particular price, then the price can only fall so far. It'd be puttable preferred shares. 16. Which of the following is least likely to be a reason for a company to issue equity securities on the primary market? So we're looking for least likely. To raise capital? No, that's a good reason. I can eliminate that. To increase liquidity? Yeah, that's a good reason. I can eliminate that. I'll take C without even looking at it. So that would be my strategy. But let's just look at it. To increase return on equity. Well, issuing more shares does not increase the return on equity. It expands the denominator. Remember, you have return on equity, ROE, equals net income over book value of equity. So if you issue more equity, you increase your denominator. That can't, oh, sorry, I said I was crossing it out. Yes, C is the answer on that one. 17. Which of the following is not a primary goal of raising equity capital? To finance the purchase of long-lived assets? Well, that is a goal. We're looking for a false statement. That's a true statement. Let me eliminate that. To finance the company's revenue-generating activities? Yeah, I can eliminate that. My answer is C. But I'm going to keep going and see what I get. To ensure that the company continues as a going concern. Sometimes you raise capital to do that. You need capital. You raise equity to continue as a going concern. But it's saying not a primary goal. The primary goal of raising equity is to buy long-lived assets, is to contribute to the company's revenue-generating activities, or to finance them. This is not a primary goal of raising equity. 18. Which of the following statements is most accurate in describing a company's book value? Book value increases when a company retains its income. Well, retained earnings is part of equity. Yes, it would. That is a true statement. That's most accurate. So we can take A and move on because there cannot be two correct answers. As soon as we got a statement that is true, you can't have a dilemma. There are no dilemmas. It's just one. But we'll read them. Book value is usually equal to the company's market value. That was a waste of time. That's simply not true. The ultimate goal of management is to maximize book value. No, the ultimate goal is to maximize market value. So notice that we can eliminate these two. Listen, you see me underlining things. I want to make this point because it's more powerful than you think. When you look at these questions, some of them will be worded positively, which is most correct, which is most accurate, which is most likely. Some of them are worded negatively, which is least correct, which is not a true statement, which is not, which is least, which is, those kind of things. You're going to have 3 or 4 in a row that are written positively and a couple that are written negatively. Once you get into the habit of looking for the right answer, when you get to a negative one, there'll be a right answer in there. But you're looking for a negative one, you're looking for a false statement, not a true one. Your motivation might be to circle the true one when in fact you're looking for the false one. Be careful about that. You'll get into the habit of looking for that's positively worded. When you get to a negative one, your mindset is already in that positive mindset, which is why when you get to every question, erase the board in your mind about positive or negative statements. Which of the following is not? Make sure you circle exactly the direction of the question, whether it's positive or negative. Draw your eyes to it. Say, okay, circle it. Say, I'm looking for a negative this time. If it helps you, write down F or write down T at the very beginning. T guides you. I'm looking for a true statement. F guides you. I'm looking for a false statement, because you will mess up on those questions. And if 10 of them get you, well, that's significant enough, right? I mean, so I can't stress that enough, that you will get into a habit of 3, 4. If you get 3, 4 in a row that are positively worded, the next one your mind will automatically default to a positively worded answer. You'll be looking for a true statement. You'll circle a true statement when you should be looking for a false statement. Be careful about that. 19. Calculate the book value of a company using the following information: number of shares, price per share, total assets, total liability, net income. Well, we know that assets equal liabilities plus equity, so equity must equal assets minus liabilities. That's book value right there. Our assets are 12 million minus 7.5 million gives me 4.5 million. That was an easy one. Have I got that? I certainly do. 20. Which of the following statements is least accurate in describing a company's market value? Management's decisions do not influence the company's market value. That is a least accurate statement. I can take A right away and be done with it, because there cannot be 2 correct answers. But we're not in an exam. Let's just make sure that strategy worked. Increases in book value may not be reflected in the company's market value. Yeah, that's true, but we're looking for least. Remember, we're looking for an F. We can put a T beside that. That eliminates it. Market value reflects the collective and differing expectations of investors. That's true. That's F, and we were looking for an F. There you go. 21. Calculate the 2009 return on equity of a stable company using the following data: total sales, net income, beginning year total assets, beginning year total liabilities, number of shares outstanding at the end, price per share. What are we looking for? We're looking for a return on equity. We know that it is our net income over our average book value of equity. We don't see any preferred shares in here, so we don't have to worry about whether or not we're calculating net return on total equity or return on common equity. It's just our net income. We're told is $2 million. And our average book value of equity, we only have beginning of year totals, not end. So, okay, we have liabilities and assets. So it's our assets minus our liabilities. That gives us $15 million in the denominator. 2 over 15 is 13.3%. Do we have that? We do. 22. Holding all other factors constant, which of the following situations will most likely lead to an increase in the company's return on equity? The market price of the company's shares increase. We're looking for what will lead to an increase in the company's return on equity. If the price increases, look at return on equity. Net income over average book value per equity. Is price in either the numerator or the denominator? No, that's a false statement. Net income increases at a slower rate than shareholder equity. And we're looking for an increase, so look at your formula. If the numerator is going up, but the denominator is going up faster, you have a bigger amount at the bottom, a bigger amount than you do at the in the denominator than you do in the numerator. That would lead to a lower return on equity. That's a false statement. I need go no further. I can select C with ease. But let's read it, see if we can put a T on it. The company issues debt to repurchase outstanding shares of equity. That is true, because look at our formula. Net income over average book value per equity. So if we're buying back equity, we're reducing the equity section, we're increasing the liability section, it will improve return on equity. There we go. We have our answer. C. 23. Which of the following measures is the most difficult to estimate? The cost of debt, the cost of equity, or investors' required rate of return on debt? Well, cost of debt is very easy to measure because it has a market price, it has a yield, we can calculate it. Cost of equity, we said, was rather challenging because a lot of estimates go in there. This last one, the required rate of return, it says on debt. Well, that's just the yield to maturity. That's just whatever the market value of whatever is implied by the market price of the bond at that time. That's what investors want. Otherwise, it wouldn't be priced there. Cost of equity. 24. A company's cost of equity is often used as a proxy for investors' average required rate of return, minimum required rate of return, or maximum required rate of return. Well, it is the minimum that you're willing to accept. I mean, you're willing to accept a lot more, right? I mean, you are willing to accept a lot more. It is the minimum required rate of return.